The textbook that I'm referring is Security Analysis and Portfolio Management by S.Kevin. So in today's class, we'll be learning how to calculate the answers for some of the questions in the exercise section of Module 1. So we were learning how to calculate the risk as well as return of investment in the previous classes. These exercises are regarding the same topic. So the first question is, calculate the expected return and the standard deviation of returns for a stock having the following probability distribution. There is a set of probable returns from an investment is given and the chance of getting that return is given in the second column. The probable return rates have been given in percentage. So we do not have to make any further calculations. If the probable returns was given as prices at the end of the year, then we would have to convert it into percentage values by applying the formula P1 minus P0 by P0 into 100, where P1 is the prices given in the column as end year prices and P0 is the price at the beginning of the year. But in this question, the P1 or P0 values are not given. They have directly given us the percentage of the returns. So to calculate the expected return, we have to multiply the values in the first column with those in the second column. That is negative 24 into 0.05, negative 10 into 0.15 likewise, and then get the total to arrive at the expected returns. So let's see how that is done. See, the probable returns has been given in the question and the probability values are also given in the question. To calculate the expected return, multiply the values in the first column with the values in the second column and take the total. That is negative 24 into 0.05 will give you negative 1.20. Negative 10 into 0.15 is negative 1.50. 0 into any value is 0. 12 into 0.20 is 2.40. 18 into 0.20 is 3.60. 22 into 0.15 3.30. 30 into 0.10 is 3. So when we add up all the values in the third column, negative 1.20 plus negative 1.50 plus 2.40 plus 3.60 plus 3.30 plus 3 will give you 9.60%, which is the expected return. Now, to calculate the total risk in the investment or the standard deviation, the calculation is as follows. We have to calculate the variance and then take the root to get the standard deviation. To calculate the variance, write down the possible returns as given in the question and the probability is also given in the question. In the third column, we have to find the deviation of the possible returns from the expected return. So the expected return or the X bar as it is denoted is 9.60, which we have calculated. Now we have to deduct this value from the values given in the first column. That is negative 24 minus 9.60 will give you negative 33.6. Negative 10 minus 9.60 will give you 19.6. Because it's a negative figure, when we deducted it from the negative figure, the answer came up to be the sum of both those values with a negative value. So 0 minus 9.60 will give you negative 9.60. 12 minus 9.60, 2.40. 18 minus 9.60, 8.40. 22 minus 9.60, 12.40. And 30 minus 9.60 will give you 20.40. Now we have calculated the deviation by deducting the expected return value from the possible return values. We can see that there are some negative figures in this column. To remove that, we have to square the values in the third column because negative into negative will give you a possible value. Sorry, positive value. So negative 33.6 into negative 33.6 will give you 1128.96. Negative 19.6 into negative 19.6 will give you 384.16. Negative 9.60 square is 92.16. 2.40 square is 5.76. 8.40 square 70.56, 12.40 square 153.76, and 20.40 square 416.16. Now once the square root values has been calculated, you have to multiply the probability with these values. As we are going to multiply the values in the fourth column with those in the second column. So 1128.96 into 0.05, 384.16 into 0.15, 92.16 into 0.15, 5.76 into 0.20, 70.56 into 0.20, 153.76 into 0.15, and 416.16 into 0.10 will give you the values in the fifth column. That is 56.45 and so on. Now add up all the values in the fifth column to get the variance value. 56.45 plus 57.62 plus 13.82 plus 1.15 plus 14.11 plus 23.06 plus 41.62 will give you the variance value or the sigma square, which is 207.83. To calculate the standard deviation, find the root of the variance. That is, the root of 207.83 will give you 14.41. That is the answer of this question. Expected return is 9.60 and standard deviation is 14.41. Now moving on to the second question. A stock costing rupees 250 pays no dividend. That is, the beginning year price is given in the question. That is the P0 value. Now the set of possible prices that the stock might sell for at the end of the year and the probability of each are given in the question. We are required to calculate the expected return and the standard deviation of the return. See, this question is a little different from the previous question. You can see that they have given the beginning year price in the question and they have shown the possible prices. The year end prices has been shown in the question and not the percentage of the possible returns. We need the percentage of possible returns to calculate the expected return. So to calculate the probable returns in percentage value, we have to apply the formula P1 minus P0 divided by P0 into 100, where P1 is the end of the year price as shown in the first column of the question, and P0 is the price at the beginning, which is 250. So to calculate the possible returns in percentage or the probable returns in percentage, we have to deduct the beginning year price from the end year prices and then divide it with the beginning year price into 100. So 200 minus 250, negative 50, 230 minus 250, negative 20, 250 minus 250 gives you 0, 280 minus 250 is 30, and 310 minus 250 gives you 60, which is the values in the third column. Now to calculate the probable returns, we have deducted the end year price, the beginning year price from the end year prices, that is P1 minus P0. Now divide it with P0 and multiply with 100. P0 is 250. So negative 50 divided by 250 into 100 is negative 20. Negative 20 divided by 250 into 100 is negative 8. Third one, 0 into any value is 0. 0 divided by any value is 0. Now 30 divided by 250 into 100 gives you 12. 60 divided by 250 into 100 gives you 24. So we have calculated the probable returns in percentage, which is what we are required to calculate the expected return. Now multiply these probable returns with the probability to calculate the expected return. So we are going to multiply the values in the first column with the values in the second column to get the values in the third column. Negative 20 into 0.10 is negative 2. Negative 8 into 0.25 is negative 2. 0 into 0.35 is 0. 12 into 0.20, 2.4, and 24 into 0.10 gives you 2.4. Add up all the values in the third column to get the expected return or the X bar. And the value is 0.8. Okay. So now we have to calculate the standard deviation. To calculate standard deviation, the variance can be calculated and we'll take the root of the variance to get the standard deviation value. So to calculate the variance first, the probable returns as we have calculated is shown in the first column. The probability as given in the question is shown in the second column. Now we have to calculate the deviation. The deviation means we have to deduct the X bar value or the expected return value from the probable return values. So the expected return we have already calculated as 0.8%. We have to deduct that from all the values in the first column. So negative 20 minus 0.8 is negative 20.8. Negative 8 minus 0.8 will give you negative 8.8. 0 minus 0.8 will give you negative 0.8. 12 minus 0.8 is 11.2 and 24 minus 0.8 is 23.2. Now to get rid of the negative values, we are going to square the values in the third column, and that is what is shown in the fourth column. Negative 20.8 into negative 20.8 will give you 432.64. Negative 8.8 square is 77.44. Negative 0.8 square is positive 0.64. 11.2 square 125.44 and 23.2 square gives you 438.24. Once the deviation has been squared and the negative values have been removed, we have a set of positive values with us. We have to multiply that with the probability to get the variance. So 432.64 into 0.10, 77.44 into 0.25, 0.64 into 0.35 will give you the value in the fifth columns. 0.20 into 125.44 and 538.24 into 0.10. Now we have to add up all the values in the fifth column to get the variance. That is 43.26 plus 19.36 plus 0.224 plus 25.09 plus 53.82 will give you 141.75. Sorry, the point is not visible in the image, but there is a point. 141.75 is the variance or the sigma square. To calculate the standard deviation or the sigma, we have to calculate the root of the variance, that is root of 141.75, which will give you 11.90. So the expected return is 0.8% and standard deviation is 11.90%. Next, we'll discuss the third question. An investor has analyzed a stock for a 1-year holding period. There is a 50-50 chance that the stock, which is currently selling at rupees 60, will sell for rupees 55 or rupees 70. So in that single sentence itself, we get the probability, the beginning year price and the end year prices. See, there's a 50-50 chance. That means the probability is 0.50 and 0.50. The P0 value is 60. That is the beginning of the year price. Now the price at the end of the year is 55 and 70. They have given the prices. We have to convert it into percentage. So the P1 values is 55 and 70. Next sentence, the investor can borrow 40% margin from his bank at 10% per annum. Suppose the investor wants to purchase some shares, but he does not have the whole amount in his hand. So he is going to borrow 40% of the amount from the bank at 10% interest rate. Now, what are the investor's expected holding period yield and risk if he buys 100 shares and does not borrow? The first section of the question asks us what would be his expected return if he is going to purchase 100 shares with his own funds. He is not going to borrow anything. He is investing his own funds in the securities. He is going to purchase 100 shares. What is the risk that he is going to face and what's the expected return? Second part is, what would be his expected yield and risk if he buys 200 shares paying 60% of the cost with borrowed funds? That is, he is going to purchase 200 shares, but he is going to invest in those shares with 60% of borrowed funds. So he is going to borrow 60% of the amount from the bank at 10% interest and then invest in the shares. So what will be his expected return and the risk that he will face in that situation? That is what we are asked to calculate. Let's see. Like I said, the year-end prices or the P1 values has been given in the question as 55 and 70. The beginning of the year price has been shown as 60, which is the P0. So 55 minus 60 will give you -5 and 70 minus 60 will give you 10. Now we have to divide it with the P0 value and multiply with 100 to get the probable returns in the percentage. So -5 divided by 60 into 100 will give you -8.33. 10 divided by 60 into 100 will give you 16.66. So we have calculated the probable returns in percentage. Now we have to multiply that with the probability to get the expected return. So negative 8.33 into 0.50 will give you negative 4.117, and 16.66 into 0.50 will give you 8.33. We are going to add up both these together. Negative 4.17 plus 8.33 will give you 4.17. So the expected return percentage is 4.17 percentage. Now we are going to calculate the total risk involved in the investment, that is the standard deviation. The probable returns as we have calculated is shown in the first column. The probability as given in the question is shown in the second column. We have to calculate the deviation. That is how far the probable return is different from the expected return which we have calculated. The x bar value or the expected return value is 4.17. We have to deduct that value from the values in the first column. So negative 8.33 minus 4.17 will give you negative 12.5. 16.66 minus 4.17 will give you a positive value which is 12.5. Now to get rid of the negative value, we are going to square the value in the third column. 12.5 into 12.5 will give you 156.25. Negative 12.5 to negative 12.5 also will give you 156.25. Now the squared values has to be multiplied with the probability values. 156.25 into 0.50 will give you 78.13. You're going to add up the values in the fifth column to get the variance, which is the sigma square. And the answer is 156.26. You're going to find the root of the variance to calculate the sigma, that is the standard deviation. Root of 156.26 will give you 12.50%. So that is our risk involved in the investment. Now let us calculate what is required in the question, the A part of the question. What are the investors' expected holding period yield? That is nothing but the return. What is the expected return? And risk, that is the standard deviation. If he buys 100 shares and does not borrow. Okay, so the beginning of the year price is 60. If he is going to purchase 100 shares right now, it is currently selling at rupees 60. So he is going to have to spend 6,000 rupees to purchase 100 shares right now. What is the return that he can expect from that investment? See, the investor spent 6,000 rupees to purchase 100 shares at rupees 60 each. The return that we have calculated, the expected return value that we have calculated is 4.17. So the return that he can expect is 6,000 into 4.17 divided by 100, that is 250 rupees he can expect from that investment. Additional of 250. Now, what is the risk of buying those 100 shares? We have calculated the standard deviation as 12.50. So 6,000 into 12.50 divided by 100 will give you rupees 750. There is a chance that you might lose rupees 750 in that investment. You can expect a risk of up to rupees 750 and you can expect a return of up to rupees 250. Now going to the second part of the question, what would be his expected return, its expected yield and risk if he buys 200 shares paying 60% of the cost with borrowed funds? So he's going to purchase 200 shares. The current selling price is 60, but he does not want to invest the whole amount by him from his own funds. He is going to borrow 60% of the amount that is required for investment. So what will be his return and risk in that case? That is the second part of the question. Okay, so he's going to be investing 200 shares at rupees 60. So he's going to invest 12,000 rupees. Now this 12,000 rupees is not from his own funds. He has borrowed 60% of his funds from bank. So 12,000 into 60%, that is 7,200 is borrowed funds. So out of this 12,000 which he have invested, 7,200 he has borrowed from the bank and invested. Now what is his expected return? The expected return percentage is 4.17. So when he makes an investment of 12,000, he is expecting a 4.17% return. So 12,000 into 4.17 divided by 100 will give you rupees 500. Now the entire 500 is not belonging to you because you have borrowed a certain percentage. For borrowed funds, you will have to pay interest. In the question, they are saying that if you are going to borrow from the bank, the interest that you have to pay is 10%. This person has borrowed 60% of his investment. So for the 60%, that is 7,200 amount which he has borrowed, he has to pay 10% interest rate. So for 7,200 rupees that he has borrowed, he is paying an interest rate at 10%, which is 720. When we calculated the expected return, it was coming up to only rupees 500. But when we are calculating the borrowed funds, interest rate is 720. So whether he gets a return or not, he'll have to pay the interest at rupees 720. Now, what is the return that he gets? He does not get any return. He is getting a loss here. So the 500 minus 720 will give you a negative value, which is negative 219.6. Now, what is the risk percentage that is involved? 12,000 into 12.50. That is, there's a risk of losing 1,500 rupees in this investment. So it seems it's better not to borrow the funds and make any investment. This investment seems to be a very risky one. That is the third question in the exercise. Hope that is clear. Thank you.